In this video, we are going to learn about the rules of debit and credit. You are already familiar with the rules of debit and credit from the previous tutorial. All I'm going to do is just to lay it out for you so that you see it clearly. So the contents of this video are as follows. I'll tell you about the rules of debit and credit, and then we'll quickly put this rule to practice a little bit more to get a better grasp on the concept of debit and credit. So in the earlier videos, we talked about three types of accounts. So we said there is personal account, real account, and nominal accounts. And we also said, all personal accounts are going to be liabilities. Real accounts are going to be assets, and nominal accounts are going to be expenses and incomes, and of course losses and gains. I'm not saying that. So having known this now, and also having understood what is debit and what is credit. Debit, increase in the claims of business. Credit, decrease in the claims of business. Now we're going to learn the rules of debit and credit. Another scientific way, rule of thumb. You can just blindly follow a formula, if you will. So here it is. You have a transaction, you figure out which accounts do you want to write that transaction in, and then you say, is this account a personal account, real account, a nominal account? You decide it's a personal account. Now if this personal account, the person whose account is being written, if he's a receiver, you give him a debit. If he's a giver, you give him a credit. All right. Debit the receiver, credit the giver. This is the rule which is followed for items which fall into, for accounts which fall into the personal account nature. All right. These so most liabilities are going to be all the liabilities are personal accounts, and hence they will follow this rule: debit the receiver, credit the giver. The next type of account is real accounts, all assets. The rule for writing the transaction is you debit what comes in. Now, when you're talking about assets, you're talking about land, building, equipment, vehicles, cash, bank balance. So all these items are either going to come into the business, which means you're buying these or you're receiving cash, or you are going to sell off these things. They will go out of the business. Hence the rule: debit when an asset is coming in, credit when an asset is going out. Again, all assets are real accounts, and this is the rule that we are going to follow. Nominal accounts: debit all expenses and losses and credit all incomes and gains. So expenses and income. So whenever you are spending on an expense, spending on rent and salary, we say that it's an increase in the claim of the business, and hence we give it a debit. And the opposite, for the credit. So all of this, you already knew this. We did this. We practiced this in the previous videos, and all I did was I gave you some thumb rules. So rather than, sometimes you are confused and you need guidance, and this is the guidance that you would use. These are the rules that you would use to write the transactions in the books of accounts. Let's put these to use a little bit more. So let's say this is a transaction. The business purchases goods on credit from a company called MMT Private Limited. So what we have to do here is we have to identify the receiver and the giver. What are the parties involved in this transaction? What is happening? And accordingly, how would you use the rule of debit and credit? So let us do this. You would maintain a purchase account. The transaction really is happening between, let's say, two parties. This is the business, and this is your vendor, purchase goods. Yeah, MMT. This is MMT. This is the vendor. The vendor is supplying goods, and this is on credit. Therefore, there is a liability which is being created. Liability. This is a creditor. MMT is a creditor. Okay. So who is the receiver and who is the giver? That is the question. So in this case, your business is receiving the goods first of all. So receiver of goods. All right. And this vendor, on the other hand, is the giver of goods. Okay. And since we're talking about two companies, and both of these are artificial, or artificial legal persons, legal person, it's a company, it's a business. All the artificial legal persons, they fall into personal account, right? And the rule for personal account is debit the receiver and credit the giver. That is the rule, which means the receiver is the business. So we're going to say our business, or whatever is the name of the company, our company should write a debit. Okay, and the vendor or the supplier, which is MT, is the giver of the goods. So the rule says credit the giver. What does it mean now? So we've written it like this. So, and we also know that debit means increase in the claims of business, and credit means decrease in the claims of business. So let's verify if everything is if you're able to check everything off using the knowledge that you've gained in the previous sessions. Now, the business is going to do a debit to its own account. Now, please understand that any business prepares all the accounts that a business prepares are its own accounts. So, what is really happening here is purchase. So, it will have a purchase account. So rather than saying, my company's purchase account, or business's purchase account, or company's purchase account, we simply say purchase account. And whenever you don't prefix anything else here, it means that it is this company's own account, right? So imagine that, I'm the company, I'm the artificial person, and if I come to life, somehow, how am I going to write my transactions? I'm going to, use a notebook and I'm going to write my purchases, right? You could simply do that. So, and I don't need to write, my company's name and then purchase account. I don't need to write that. So I have this understanding. Whenever I write purchase account, rent account, salaries account, what I mean is my company's salaries which are being paid to employees, my company's rent which is being paid, and so on. So we don't need to mention, business or company's name here at all. So this purchase account represents the business in that sense. Okay. However, since this is business's purchase account and business is kind of receiving it, we have given it a debit. Although that's not the correct logic, I'll come to that in a bit. So you on the other hand, you have the vendor. The vendor is the giver of the goods, and debit the receiver and credit the giver. So using this rule, we are going to give a credit to the vendor. So the outcome of the objective of this slide was to identify receiver and giver. We said receiver is the business and giver is the MMT company. It gives goods. We credit the giver and vendor's account, MMT's account. The outcome is going to be MMT's account is going to be credit because it is a giver. All right. I'm not commenting on the first half of the transaction where there is no longer a receiver but a purchase account, and purchase account is not a personal account. All right. So I'm going to reserve that for following slides to be discussed. Let's look at another transaction where the building is being purchased for cash from PQR. Now we have to again identify who are the parties involved, how would this business record this transaction. So clearly there is something called purchase. You could create a purchase account. There is building being purchased, so you could also think about creating a building account. cash is involved, so you could create a cash account. And PQR is the person from whom the building is being bought, so you could create PQR accounts. There are four possible accounts or records that you would want to maintain. Which account should you actually maintain for this transaction is the question. Okay, so you are purchasing now. Purchase account, this is the first option. We have discussed that purchase account is a dedicated account for the goods that are going to be resold. So the goods for resale purpose, all those goods are going to be recorded in purchase account. So you do not want to mix purchase of asset with purchase of goods. So in this notebook where you write purchases, you will only write purchase of goods which are to be resold. Next option is buildings account. Now, what is building account? Building account means you have a notebook wherein you write about building. You purchased building, you sold building, you did something to the building, renovation, etc. All of that is going to be written here. In this transaction, you are purchasing the building, right? You're not purchasing goods, you're purchasing building. So, building account is the account which you should certainly create. You should create have a page or have a notebook where you write about updates on the building. Next option is cash account. Now, is cash account being affected? Are you paying cash for it? Where you purchased building for cash, you paid in cash, so certainly cash account is getting affected, so you have to consider this. And finally, PQR. Now, what is happening is you buy building from PQR and you pay him cash. Do you want to maintain a PQR account? If you maintain a PQR account, you would maintain it because you want to know how much do I owe him, how much to pay him, all right, or how much to receive from him. In this case, since you are purchasing building from him, the relevant question is, do you have to pay something to PQR for the building? The answer is no, because you already paid in cash. So if you have already paid in cash, why do you need to maintain a record? It is a waste of effort. You don't need to record because there is no record. You paid in cash. So whenever you pay in cash, you don't worry about the vendor because you don't owe anything more to the vendor. In the vendor's account, you are only going to write whatever is due to him, which you have not paid. So in this case, PQR is going to be excluded. So we have arrived at two accounts where this transaction should be recorded: building and cash. Now, building is an asset and hence a real account. Cash is also an asset and hence a real account as well. What is the rule of debit and credit for the real account? The rule for debit and credit is debit what comes in and credit what goes out. Both the items are assets. Since you are purchasing the building is coming in. So you would say building is coming in and hence you should write a debit for it. On the other hand, the cash is being paid, so cash is going out. So you should write a credit in the cash account. There you go. That's how you identify what comes in, what goes out, and also how to identify which accounts you should write the debit and credit into. All right, one more transaction where we will try to identify the income. Cash sales made to XYZ. Let's look at possible accounts where we may want to record this transaction. Cash, first of all. So one possibility is where we write this in the cash record. Then you have sales which are being made. So you have sales account. Then you have XYZ Limited, your customer. XYZ Limited's account. Three possibilities three accounts where you could write this transaction. So first of all, cash sales are being made. So cash is certainly coming in. So you do want to write, you do want to record in the cash account so that you know what is the cash in the balance and what is balance in my according to my notebook that I have. The second account is sales account. Sale account refers to the income from goods sold. All right. So sales are certainly being made. Cash would be coming in because you are selling the goods. Goods are going out of the business. So sales account is actually a goods account. We don't write it as goods account because we like to maintain separate sales. Understand that goods are purchased and goods are sold. Maybe I should clarify it here. So goods and goods. Goods are first purchased and then they are sold. All right. So we could maintain one account, single account, which would be goods account, but we don't do that. Why? Because purchases have a cost price and the sales have a selling price. That's how you make profit, selling price. So these two prices are different. This is typically lower than the selling price. So we like to maintain different records for goods that are purchased and goods that are sold so that we can calculate our profit. More on that later in the course. We will come across this more. So in this transaction, sale is certainly an account which you should consider recording. The last option was XYZ Limited, which is the customer to whom you have sold. Do you want to write into XYZ Limited's account? What are you going to write? He's a customer. So you would write, if you have to, do you have to recover money from him? Recover money for the sales, right? According to this transaction, no. Why? Because this is cash. He has already paid you. So why do you want to bother writing in his, account, his record that you maintain? So we just want to ignore it. You don't need to write in the account of the customer. You just need to be bothered about cash account and sales account. All right. Cash is an asset, sale is an income. Asset is, again, the rule for asset is different, for incomes is different. Rule for asset is debit what comes in and credit what goes out. I'm just using shorthand for this. For incomes, you have debit all expenses and losses and credit all incomes and gains. So going by the rule, I'm going to say cash account debit because it is coming into the business. On the other hand, you have sales account, which is an income account, and credit all incomes, and I'm going to say credit. So I'm utilizing this rule here and this rule here. There you go. That's how you identify income and you decide if it is to be debited or credited. Last transaction, we have to identify expenses here. You do cash purchases. You have cash account. You are doing purchases. So you say purchase account and you are doing the purchases from ABC Limited. So ABC Limited's account. Now, as discussed in the last two transactions, whenever you're doing cash purchases or sales, don't worry about the party with whom transaction is being done because you don't have to recover from him, you don't have to pay to him. So the only two accounts which you should be bothered about are these two, cash and purchase. Cash is an asset and hence real account. Purchase is an expense and hence a nominal account. We had to identify expense, and expense in this slide is purchase account. And if you are thinking how come purchase is an expense account, it is supposed to be the goods account and goods are supposed to be assets for us. Well, think of this. I clarified this in another video before. Already I've done that. Purchase refers to the value of goods that have been sold. So we are not referring to unsold. The stock of goods is typically unsold. All right. So this is an expense, and the unsold goods are an asset, a current asset. Okay. So in this case, purchase refers to the value of goods that have already been sold, and hence they are treated as an expense. All expenses are debit, so you're gonna write, purchase account, you will write a debit against the purchase account. There you go. So we had to identify the expense. We did that, and we also went another step ahead and we said we should debit it because the rule says so. All right, so that was a quick discussion on how do you identify what are the rules of debit and credit, and how do you identify which accounts are involved in a transaction. In the next video, we're gonna go to the first book of the entry, which is journal. So now you have all the equipment, all the tools that you need, all the concepts that you needed to learn in order to write the transactions in the books of accounts. So building blocks are over, and starting next video, we are going to actually pick up the first book of account and take a bunch of transactions and use the rules of debit and credit and write the transaction as it is written in the business.